So I want to ask the question, do you see a gap between the demographic trends and the market's perception of commodity demand or valuation?
I do, generally speaking. I think that, demographics, these demographic changes play out over years and sometimes decades. The phrase is that goes that, demographics is destiny, and that implies sort of a long-term view or a long-term focus. But, right now, what we're going through in the commodity markets, I look at it as a near-term blip. I mean, I don't think that this commodity super cycle is over with by any stretch of the imagination. China may not grow at 9 or 10% going forward, but this is still a country of 1.3 billion people that's going to grow at, say, between 7 and 8%. So, based on that, based on the demographics and the commodity demand that implies, we're very optimistic going forward for a whole host of commodities and the commodity demand in the coming years.
Based on what you've just said, is there a valuation gap opportunity for investors?
I think there is, and I think that is not a blanket statement. I mean, in other words, I think you need to look at specific metals or minerals to really find those valuation gaps. If you go back and you look at uranium in 2004, it rocketed up to its ultimate peak at $140 a pound. And then you look at what happened with lithium. Everyone jumped into lithium. And then, of course, the most recent example is probably rare earths and what's happened there. Ultimately followed by, I think, the current mineral of the moment, if you will, which is graphite. So, what I encourage investors to do is take, obviously a top-down macro view, but go out and find those metals and minerals that have supply-demand fundamentals that look like they're out of whack going forward based on big picture trends such as demographics.
Speaking of gaps between supply and demand for some minerals, explain to us what strategic and critical metals are.
Sure. The strategic and critical metal theme is something that's really rocketed to the forefront over the last few years. And it's difficult to really describe them. And it's difficult because everybody seems to have their own definition. I like to keep it pretty simple. I'd say that a metal is critical if you can't produce an end product without it. In other words, there are no substitutes. A metal is strategic if it helps bolster national defense, for example, or helps bolster that middle class growth that I mentioned before. Here an example would be lithium. Lithium is critical to the manufacture and production of a lithium-ion battery. In other words, you cannot make a lithium-ion battery without lithium. For example, with respect to strategic metals, you can look at the rare earth elements. They are strategic for their role in high-temperature permanent magnets used in national defense applications like tanks or radar. And I think what's really fanned the flames, if you will, of this whole strategic or critical metal theme, again, is China. China controls the lion's share, if you will, of production and consumption of a whole host of metals and minerals. And just from the United States perspective, we're 100% dependent on imports of 18 metals and minerals and at least 75% dependent on a total of 31, and China controls the bulk of that production. So, it's never a good idea to rely on a strategic adversary, if you will, for your raw materials, and that's unfortunately the situation that we find ourselves in here in the West.
What are the geopolitical ramifications of that supply imbalance?
Well, I think the geopolitical ramifications are huge, and I think that they can play themselves out, rather quickly. I think your own self-sufficient raw materials or mining policy really plays into job creation. It plays into self-sufficient supply chains in not just high-tech applications, but also national defense as well. And, the United States with, let's just say, an 8 to 9% unemployment rate, you would think that politicians in this country would be coming back to the mining industry, if you will, to figure out a way to set up supply chains and create the jobs. But for whatever reason, that just hasn't happened over the last couple of years, and I think politicians ignore it at their own peril.
Chris, you and your father, Dr. Michael Berry, contribute your thoughts on a regular free email blast called Morning Notes. What are your morning notes, and why do you send them out?
Morning Notes is a newsletter that my father, like you mentioned, Dr. Michael Berry, started writing about 10 years ago. He has sort of a varied career history, if you will. He was a professor of finance at the Darden School at the University of Virginia. So he was steeped in financial theory. And he graduated from that, if you will, into money management here in New York City. And based on those two different careers, if you will, he developed what he calls discovery investing. And the theme which underpins discovery investing is the idea that all wealth is created ultimately from a discovery, whether or not it's a discovery of a high-grade gold vein or, for example, a biotech play, if you will, that discovers a cure for a certain type of cancer. Really what we do with discovery investing is we're top-down investors, so we look at broad macroeconomic analysis and trends, many of which we've talked about today, and then we go out and we turn that around and we look for select discovery companies, or discovery names, as we call them, that we think are, over the longer term, positioned to appreciate based on these macro trends.
I understand that you developed a software around your discovery and investing model. What does this software do?
Sure. This is a piece of software that my father and I, and also another gentleman by the name of Dr. Terry Rickard, have developed. And one of the challenges in investing in the microcap space, whether or not it's commodities or biotech or high tech or what have you, is very subjective. You know, these companies typically don't have cash flow or earnings or revenue, so you can't use traditional discounted cash flow models to evaluate them. So what we have done is our discovery investing model is focused on 10 specific company-specific factors. So you ask a question, for example, is the asset world-class? Is the management capable, and are they experienced? And the discovery investing software uses an algorithm, and what this algorithm does is it basically asks you to answer each one of those questions. But rather than using a number, say 1 out of 10, you use a word score. So you might say that, management is very good. I might say management is poor. You might have a different opinion based on each one of the 10 factors. And then what we do is we use this computing with words methodology to create a crowd score. So the idea with the discovery investing scoreboard is that you can use it and you can benefit from the wisdom of crowds.
I'd like to get you back in the studio to further explain the program and its implications.
I'd love to. We'd be delighted to. We released the software in January of this year. We have about 700 users and about 650 companies that are scored. So it's growing, and we think it potentially offers a very unique way to evaluate companies in this microcap space.
Chris, thank you very much for the time, and I appreciate you coming on to Kidela.com.
Thanks for the opportunity, Rob. It was a pleasure.
We've been speaking with Chris Berry. For more information on the topics Chris talked about today, please visit Kidela.com.